Now we're getting into how to make money in these plans.
Mm-hmm.
And this is the part that I like, the rules and the regs, you got to wade through that and you got to understand. I mean, you got to learn the rules to the game before you can play. But now that you've learned the rules to the game, let's start winning, and we're going to start figuring out how to take this. Now, I want to preface by, I started my plan with like hardly any money in them at all. And I didn't put money in out of my pocket for years. As I've mentioned maybe previously, as I got into higher income brackets and higher tax brackets, I started to put money in out of my income just to get it off of my books as income for the year. I'd put it into the 401k and defer the tax, on that amount, which I think between my wife and I was around $107,000 or something we could put in and be matched by the time we got matched and everything. So we deal in real estate. And I think let's just take one of the most common ones. We'll talk with rentals first, because a lot of people do rentals.
Sure.
First of all, when you go to buy these things, you put the contract, the purchaser on the contract is the PSP account or the 401 account, whatever you styled that account name. So it might be the Mitch Stephen Retirement Fund, trustee Mitch Stephen, PSP, right?
Yep.
All right, so it stands for personal...
The PSP is for profit sharing plan.
I'm sorry.
Yeah.
Profit sharing plan. That's what PSP stands for. So it'd be Mitch Stephen Trustee -PSP, profit sharing plan. Or if there was an LLC, you could do whatever that LLC's name. If the beneficiaries
Yeah, we could have an LLC be set up inside the 401k, and now have the LLC going out and acquiring the property, and we just take it down in the name of the LLC, and everything relates back to the 401k. So that works as well.
Okay, I put everything I got in a land trust. Does that make any difference?
Doesn't make a difference. We just say the beneficiary is the 401k, Mitch Stephen, trustee of the 401k. That's all.
All right. And then a lot of title companies get confused by this. But so you just, really all I ever do is just tell them, just treat it like it's a trust, any trust. You guys have bought and sold properties in and out of trust before. This trust is buying a property.
That is exactly what you need to do, because they're going to freak out whenever they see it's a 401k. Title companies just freak out. So you just tell them, hey, calm down. It's a trust. Treat it like a trust. And they're going to ask for a certificate of trust and all that other stuff. But at least now they have a reference point of what they've done in the past, and you can move forward with the deals.
Then the other thing to know about this real estate is the retirement account can owe money on a rent house. Say like the seller of the rent house wants to finance it to the retirement plan. It finances it. You just can't sign a personal guarantee. The owner of the plan or the trustee or a fiduciary of the plan or all these disqualified people we talk about cannot guarantee that money. But usually if there's a seller financed deal, it's usually a collateral only loan, and that's fine, right?
That's fine.
Now, there's consequences. If it's a seller finance deal, you got to be careful with it, because there's an exclusion of the debt financed income rules, which is the one where you have to pay taxes on leveraged real estate deals. 401ks have an exclusion for that, but under some cases, if it's seller financed, you lose that exclusion. You just have to have some right language in the contract to make it work right.
Okay, and you're talking about UBIT, is that right?
Yeah, that's part of the UBIT rules, yeah.
Okay, UBIT rules.
Yeah.
Okay, so if you're gonna, I'm just gonna say this flat out. If you're gonna have financed real estate, pick up the phone and make a phone call before that transaction goes down or before the contract's even written, right?
Yes.
Because you may have to include some language in your contract that would be beneficial to you in the long run. Okay? You can't purchase from a disqualified person. That's a given, right?
Yeah.
Same as anything.
Yeah.
Disqualified person can't give services.
Correct.
Like you can't be paying your kids to paint the house that your PSP account owns.
We see that a lot, actually, Mitch. Or paying the kids to mow the yard and all that other stuff. Doesn't work. No bueno. Can't do that.
All expenses from it says all expenses from plan. So you can't pay for expenses out of your pocket, like the lawn mowing or the tree trimming. All the expenses got to come out of the plan.
Yeah, I had a case, actually a bankruptcy case, where the bankruptcy trustee was trying to take away the real estate owned by somebody's IRA, and the reason being is that somebody used their personal money to pay for the insurance on those properties. They did something bad, and just because they did that one little foot fault, the bankruptcy trustee now is going to take away $200,000 worth of real estate. We're able to fight it and save it, but that was a bad thing. They shouldn't have done that.
It cost them a lot of money.
It cost them a lot of money. I charged a lot as an attorney.
Well, I don't know any real cheap attorneys, and you probably don't want a cheap attorney.
No.
Sometimes cheaper is not better, right? Make sure, again, that a disqualified person or yourself or your trustee or whatever, they don't get commissions from the sales or any kind of benefit at all from it. And you got to consider, well, let me say, I'm trying to read my notes here, but
Sorry.
This one says, consider selling off the depreciation. Now, I don't know what that's about. I never heard of that. You can sell depreciation rights?
You can sell depreciation rights.
Yes,
Wow,
sir.
so this is, man, I learn something every day. So you're in this tax deferred or tax free entity doing this stuff. You don't need the depreciation off of this. So what I think he's fixing to tell me is I could sell my depreciation to someone who needs the write-off.
Is that going to make you happy, Mitch?
Well, I should be buying a lot of depreciation from people.
You really should.
I should be buying it from other people.
You really
and I
should.
should be, or at least trading.
You really should.
I
There's
had
a
no
lot of
idea
people-
you could do that.
Yeah, I mean, I hear this all the time. CPAs trying to, bust my chops about, oh, we're losing the depreciation inside the 401k. I say, yeah, some people do, but some people know how to use it within the 401k plan. But also, some people, they sell off the depreciation. And they don't know what they're talking about, the CPAs or what have you. They're confused by that, but there's ways you can sell off the depreciation.
Well, you can also sell off tax benefits, right? Or tax write-offs. If you don't use them or you have too many, you could sell tax write-offs. I've heard of that, right?
So long as you do it right, yes.
Yeah. Wow. Okay, so let's move from rentals to flips. It's
Okay.
all about the same. Again, you might generate some UBIT. Tell me an instance where you're doing a flip that's going to generate UBIT.
The UBIT rules don't have anything regarding flips specifically. But what they say is if you're running a business, an ongoing business inside your retirement plan throughout the year, you owe taxes on the profits you've generated from that business. Generally speaking, flips are a business if you do too many. And then you're going to ask me, how many is too many? And I'm going to say, hell if I know. It's really what the IRS agent's going to assert, and you're going to come back and say, no, those were investments, not running a business. So it's going to be a negotiation, for lack of a better phrase. There's no fixed number of how many flips is going to cause an issue. But I will tell you, there was a key court case a few years back about somebody being a trader in securities in the stock markets, buying and selling real fast. And the IRS said, hang on here. You only made your money from January to April. You stopped from April and you partied from April to December. That wasn't a valid business. That wasn't a business you were doing throughout the whole year. So now what we can do is we can use the same logic as that court case, do 30,000 flips, from January to April, take the rest of the year off of the retirement plan, not have it do deals, and now if they give you any guff, you can cite back to this court case and say, hey, well, what about this case and its logic? I'm not saying that's the way you should do it, but that's a little defense that you've got going on.
There's a lot of questions about what's working in an IRA. What constitutes working out of your IRA?
Yep.
So let's help me more. Like, what? So how do you avoid that? Like, say you are a person that wants to put a house in every month in your IRA. How do you make it okay?
Well, first thing is, it's all about opportunity cost. If you can knock it out of the ballpark doing these flips, even after taxes, it might make sense to do them. Now, how do we alleviate the tax burden? Because the tax burden on flips is going to be 37% inside your 401k. That's not good. So what we can do is we can wrap up the investments inside of a C corporation. C corporation top tax bracket's 21%. So right off the top, we can come close to wiping out half the taxes if you're going to be doing the flips inside there. Other than that, there's no real way to avoid it or save it. There's a couple of things, but they get really complicated, and we really can't protect 100% of the profits. If you're making 50% on your money, we might be able to protect some of that, but not 100% of the profits. So best thing is, if you're going to be doing a lot of deals, do them inside of a C corporation owned by the 401k plan.
Yeah, or why don't you do them in someone else's C corporation and just buy the notes at the end of the day? Or I don't know. Can you put them? Can you put houses in individual trusts or land trusts and just buy trusts?
You can, but the trusts are going to be passed through, and all those profits are going to come down as that business income once again. But you just hit it on the head, and I forgot we even talked about this last night. What a lot of people do is somebody else acquires the things, and now the retirement plan just buys the note that is created off of it.
If you're doing like an owner finance business, like what I do,
Yeah.
you would just have people out there that acquire these houses. You loan them the money to acquire the houses. I don't know. Does that work? If you're loaning on them, no, they'd have to get the money from the third party. But
Well, you just buy the note. Once they've created the note,
Yeah.
you buy the note, and a lot of these notes are trash, really, so you're going to buy them at a discount, and now whenever the interest comes in, that's interest inside your retirement plans.
how much does it cost to form a C corp though? For every, can you do a C corp? Easy forms or is that not?
Corporate easy, C Corp easy. You could, but here's the other interesting thing. Each time you do one of these deals, you don't need a separate C Corp. Only thing that's going to do is make me rich. Well, hold it. Yes, you do need a separate C Corp.
Yeah.
But no, all you need is one, and you can just do all the deals in there. Much does it cost to set up a C Corp? We typically do C Corps. Gosh, I think it's $300 over state filing fees. So it's really not much in the larger
$300
picture.
over whatever their state filing.
Yeah,
fees
and
are.
state filing fees are about $135 or so.
I think that about wraps up. Anything else you know about to talk about in real estate investments?
That pretty much covers it with the real estate. The big thing is make sure you take title to the property inside the name of your plan or an entity owned by your plan. Don't take title. I see a lot of people, they drop the contracts or take title in their personal names. And sad trumpet sound, wah, wah, wah. That's a mess. We got a disaster now.
Yeah, now it's not an arm's length transaction because your name's all over it.
Yep, exactly.
All right, let's move on to segment 25, which is investments like where you loan money.